How's it going, everybody? It's Blake Ragland here with Bradshaw and Will. I'm sitting down with Brandon, our certified financial planner again, and today we're going to talk about the 2 phases of retirement planning. So, Brandon, first question I have for you is, what is the key to achieving a retirement where I can be confident my financial goals are going to be met?
I think step number 1 is to design a plan that is well put together, that will last no matter what happens to the stock market, to the economy, that where you take your goals and you make sure your plan is reaching these goals. And then secondarily, it's just persistence. Can you stick with this plan over a long period of time until it's time to retire?
Okay. Well, and I know everybody's retirement goals are a little bit different, and you hear about people saying, I've got this magic number I'm trying to meet before I retire. But how do I know what my magic number is and how to achieve that magic number?
Okay. Magic number is a phrase I see a lot of times in the financial press. And what they're saying is, Blake, if you save enough to hit what your magic number is, let's say it's $1 million or $2 million at the time that you retire, you've done all you need to retire, right?
Right.
You've reached what you need to do, and it's a done deal. You're going to retire confidently.
Right.
I think this is a very dangerous strategy. So I'm not really a proponent of somebody just focusing on the magic number.
Mm-hmm. Okay. Well, I mean, before we dig into the start of the phases, what makes that so dangerous, that magic number? Because you hear that a lot.
You do hear it a lot. And on the one side, I think it is important to start early and to put in as much in as you can afford. So that part is good. The problem with it is all the focus is in the accumulation. Just hit this number. When in reality, once you retire and start drawing money out, that's when it becomes much more complicated. And if you have negative returns early in retirement, that can really put your portfolio in a downward spiral. So it's much more complicated than just hitting a magic number.
Okay. Well, I know you mentioned accumulation, and that's what I have here for phase 1. Can you kind of dig into that and see what's so important about this accumulation phase and how to keep building that retirement?
Right. Phase 1, again, is the accumulation phase, and I think that's the phase most people are more conscious of.
Right.
And this is simply where you are putting money aside for retirement. Typically, the earlier you start, the more you put in, the better. When you're years away from retirement, typically the more aggressive that you are is better, because even if the market does go down, and it will from time to time, these are actually opportunities to be buying at a discount. So phase 1 accumulation is simply just being very persistent, and the ability to defer gratification, not buying a lot right now, but investing for the future.
Okay. Yeah. That makes a ton of sense. Now, what kind of advice would you give to people who are in an employer-sponsored plan, like a 401k or a 403b? Is there anything in particular that they should form some habits or anything like that?
That's a good question. So for those out there, 401k, 403b, these are type of employer-sponsored retirement plans. They offer the ability to put more in than you typically could on your own if you have the ability to do that. And a lot of times they offer a company match. And so my advice would be, if you're young and years away from retirement, typically you want to invest fairly aggressive, because again, we say the market tends to go up over a long period of time. As far as strategies with the 401k or 403b, you always, if you can afford it, want to put in at least up to the company match, because this is money the company is giving to you, so that's always a good idea. Beyond that, I would look to see if there's a 401k Roth option available, because this would allow you to put money in that's going to be tax-free at retirement. If there's not a Roth option, then I would look for tax-free options on your own to stop after the company match and look at Roth or tax-free options on your own. Could be Roth, but there are limitations on how much income you can generate to be eligible here. If that's not available, you might look at other options. Cash value life insurance, if put together properly, could be one option here also.
Okay. Now, you and I have talked about how phase 2 is very complex. Can you kind of dive into phase 2 and what are the things that make it so complex and important to be aware of these different risks?
Right. Good question, Blake. So phase 2 starts the day you retire that you no longer have a paycheck. And you think the whole time that you're working, you're getting this regular paycheck. If you get paid every 2 weeks, you're getting it every time. You're getting a regular paycheck, right? So you don't have to worry about the money coming in. Now, once you retire, those paychecks stop. You get this lump sum, but you got to figure out how to turn this lump sum into income that'll last the rest of your life, the rest of your spouse's life, no matter what happens to the stock market, no matter what happens to the economy. So if you make mistakes, it's possible that this lump sum gets spent too quick and doesn't last for your whole life. And so especially what makes it more complex is, or more dangerous is if in the early years of retirement, if the stock market have negative results, that can be very detrimental to your investment portfolio.
Okay. And last question I really had is, so if we've got both phases of retirement taken care of, so
right.
phase 1 accumulation, phase 2 distribution, are there any other things that we need to concern ourselves with in retirement?
Right. Great question. So those are the 2 phases, and to get through phase 2 distribution, the key again is to develop a confident stream of income that you can count on. And then beyond that, what you want to look at is protect yourself from other risks that are out there. We see inflation popping up right now, right? Prices of gas, groceries, different things like that. That's something you have to be aware of. Taxes are probably going to be going up in the future. Be aware of that. Long-term care could be a problem. So there's other risk to your retirement nest egg that you really want to be aware of and really want to put together a plan to address.
Well, I know we went through phase 1, phase 2. Our next video, and I have in my notes, is to talk about the potential retirement danger zone.
Okay.
And I know you've got a lot of knowledge on that, and I'm sure you'd love to share it with a lot of our viewers. Can you kind of give them a brief preface to this video and kind of what to expect?
Yeah, thanks for bringing that up, Blake. Again, there are the 2 phases, accumulation and distribution. The danger zone basically is just that period of time just before and just after retirement. This is a period of time that is especially critical for decisions. There's a lot of decisions you have to make, whether it be with your investments or other decisions out there. And what we have found is this is the most critical time to make sure that you make good decisions. So that's what we'll look at on the next video.
Okay. Everybody tunes in for that video because that's going to be a really good one. But those are all the questions I had for you today. Thanks everybody for tuning in and watching. Tune in for our next video on the potential retirement danger zone, and we'll see you next time.